Hey, everybody. Thank you for tuning in. We are pleased today to be joined by Tyler and Alex from GoNoGo Trends. Recently, we've had the good fortune of being able to add their GoNoGo indicator to the TrendSpider platform, and the guys are here today to walk us through how to utilize it. So, Tyler and Alex, thanks so much for being here today. I'm really excited to learn more about this indicator.
Absolutely. Jason, thanks so much for having us. And hopefully one day soon we'll be able to do this, in 3 dimensions, back in person. But we're,
Yeah.
we're really excited about all the work the TrendSpider team has put into this, and really want to thank Dan and Jake and Ruslan and the whole team that's made an awesome implementation of GoNoGo charts.
Yeah, great. Yeah, we're really
Absolutely.
excited about it.
Yeah, thanks for having us.
Absolutely. So walk us through this thing. How does it work?
Absolutely. So, for Alex and I, getting together about 12 years ago, we both have a passion for education, and clearly we both have a passion for technical analysis. Alex and I first met doing some trainings with a company called Bloomberg. Both their staff and their clients needed to understand a little bit about how responsible investors use technical analysis, always in the institutional setting. And I got started with the CMT Association well over a decade ago, which is the global credentialing body. It's sort of the Wall Street equivalent of like CFA, but for technical analysts, portfolio managers, traders, hedge funds, you name it. So Alex and I have worked long and hard with the institutional community, and we realized that a lot of the tools and the discipline and the process can become cumbersome to individual investors or folks who are new to trading. And in fact, it can cause a lot of analysis paralysis when you start to use all of the technical tools on your charts. So we wanted to focus on something that was simple and elegant, but still captured all of that information. So we're going to talk for just a minute about trend following investment strategies, and how you could use GoNoGo charts to be a responsible, disciplined trader. How's that sound, Jason?
Sounds awesome. Let's do it.
Awesome. All right. So we can't talk about trend following without recognizing some of the greats. This gentleman, John Henry, came from pretty humble beginnings on a soybean farm, and learned the commodities trade from his family, but realized that quantifying what he was doing, looking at price and objective results like price trends, really helped them stay on the right side of trends. For those of you watching, John Henry might be a familiar name if you've read the book or seen the movie Moneyball. And so the idea of sabermetrics in the baseball setting was, let's remove all of that bias, all of the narrative and the noise, and we're predisposed to think certain baseball players might be better because of their pedigree or their family name or whatever it might be. And instead, they just focused on the statistics of those players, and they put together a really great team that won a bunch of championships. Well, John Henry has gone on. He actually owns the Liverpool Football Club and Roush Fenway Racing, and as well as the Boston Red Sox. Pretty successful investor in his own right, running the fund for Boston University. The point here is that GoNoGo charts are not a quantitative tool like a black box AI. We're not here to teach you guys how to code in Python. But when we say quantified, when we're talking about objective tools, it's about our ability to separate emotions from what is actually happening in the marketplace. And for those of us that get caught up in the 24-hour news cycle, you know that there is always a narrative being spun about what's happening in the marketplace, and that can cause us to make really bad trade decisions. So technical analysis is incredibly helpful, incredibly powerful in helping people focus on just what is happening rather than what they think or expect might be happening. So we're going to get mathematical for just a second. We're going to talk, first year business school. Let's talk about the expectancy formula. Obviously, there's 4 outcomes to any trade that you put on. You can have a small loss, no problem. You can have a small win, that's great. A really large win, that's fantastic, or really large loss. And it's those portfolio crushing, career ending losses that we have to get rid of. So for everybody, myself included, we've all had those trades that then became investments. We just had such high conviction in whatever it is we thought about this stock or this security that it was going to come back in our favor. And so we held on to it long after it was a bad trade, down 4, 5, 10, 15, 20%, maybe even more. And the losses mount up because we believe that we'll get back to break even. Now, the reason that that happens to us is very well explained by Nobel laureates like Daniel Kahneman and Amos Tversky, who understood prospect theory and the idea that we are much more rewarded for avoiding a loss than the joy that we experience from gains. Meaning, we hold on to those losers because we cannot admit defeat. We hope that it comes back to break even, and we cut our losers too short, right? John Henry tells us we got to let our winners run, we got to cut our losers short, but we have a really hard time doing that because of something called prospect theory and all of those behavioral biases that get involved. We're just too eager as investors to lock in a profit, and we're too stubborn to recognize our losses and get out of those quickly. So go-no-go charts were designed for really two purposes. If you look at the chart on the right side of the screen, what we're looking at is the expectancy formula, and all profitable trading strategies are going to be to the right of this curve. Sorry, 1 second, Jason. Here we go. So this is where we break even. Any combination of the percentage of winners and the profit ratio. So we could be right 80% of the time, and basically our wins just have to slightly outpace our losers. If you know how to pick winning trades 80% of the time, by all means, please call Alex and Tyler right away and let us know your secret. The institutional folks that we've been working with for decades, they know that some of the best research and material, the best edge that they can find is probably going to get them no more than 60 to 65% winning trades. They know they're going to be wrong a lot, which is just fine, because when their winners outpace their losers, when they're able to hold on to those trends, to be patient investors and stick with it, they're able to capture those really outsized gains. Paul Tudor Jones and many other fund managers have talked about how you could be wrong most of the time and still make money, be profitable over time, because you have these outsized winners that eat up all of those, small paper cuts you take on small losses. So the idea is to find profitable trading systems that have a high percentage of winning trades and help you with your trading discipline. That's what GoNoGo charts are here to do. Put the probabilities on your side to get involved in trends that show the aspects of durability, but also to help you control your investor behavior, remove some of those subjective biases, and just focus on what's happening. All right, Alex, I know one of your longtime mentors and friends from your Bloomberg days, Dave Keller, really influenced how you looked at technical analysis as well, correct?
Absolutely. And, we used to talk all the time about having a routine and having a disciplined process for investing. And he's a pilot. And so he would always talk about that sort of gut wrenching feeling when your instructor would shut off the engine and you're floating around in a tin can. But you have to have a checklist to go through to help you in situations like that. Maybe you've just knocked a switch off and you can turn that back on. And if you go through a disciplined checklist, that's how we prevent really serious mistakes. And the same is true for investing. You might have a technical checklist that includes things like trend lines, moving averages, different indicators, and that checklist will help you understand what you're looking at in terms of the trend of any security that you're currently studying. And so if we were to think about that, you can create something that's really sophisticated with indicator after indicator and indicator after indicator. But the problem that we've found is that then it gets complicated and you're left with a chart that is overwhelming. It's a chart that becomes hard to read because you can no longer see price action. You can't find key levels. You can't find important supply and demand areas on the chart in form of support and resistance. And we've seen this time and time again throughout our work in technical analysis.
Now, when I first started at the CMT Association, we're not talking about these technical tools being wrong. In fact, some of the great mentors like John Bollinger and Ralph Acampora and people who invented and really gave life to a lot of the indicators that we enjoy today, they talked, over and over and over again about how important those tools were in conjunction, how you would use things like trend plus momentum, using volume as a confirmatory indicator. So we're not here to tell you that using those technical tools is wrong. But what we have learned outside of the institutional space is that oftentimes that can create redundant and even contradictory signals on your charts. If you're like me, if you put enough lines on there, you can convince yourself of just about anything. So, Professor Cole, we're going to turn it back to you. Alex and I actually got to work together as well when I was with John Wiley and Sons, doing all of the prepared content, the preparatory classes for the CMT exams. Chartered Market Technician is what that stands for. So, Alex is the resident subject matter expert who has taught all of the classes for the CMT program, Technical Analysis 101 through the more advanced stuff. Professor Cole, why don't you talk to us a little bit about how institutional investors would identify when a trend begins and when it's come to an end?
Yeah, and I think it's important to note this is arguably the most important skill that we have in our industry. If you can identify a trend in price action, then you can profit from the majority of the move. Now, we like to say that this is simple, but it's not easy. But what you want to do is try to identify first, visually maybe, whether anything is happening on the chart. And if you did it just by looking at what you're seeing, you could say, yes, there's a discernible direction of price on this chart. It's moving from the bottom left to the top right. You're seeing a series of higher highs and higher lows. But remember, we want to make this as objective as possible and remove subjectivity. So you might want to automate that. First thing you might put on your chart is something like the Donchian channels. And if you're familiar with the turtle traders, it's an amazing story about Richard Dennis training people to trade like they almost grew turtles that he'd seen in his travels. They use the Donchian channels as one of their main entry mechanisms for getting into a trade. So you can see that the Donchian channels move up as a new high is being made over a certain look back period. You might throw on something like a Bollinger Band then, where you're seeing that when the bands narrow and price breaks out of the band to the upside, you might think that you're going to trade in the direction of the break. Bollinger Bands have several interpretations, but the one for trend followers is that when those bands tighten and narrow, and then we see price break to the upside, then we might trade in the direction of the break. You could also throw on a moving average. Pretty much every chart you're going to see will have a moving average on it. We used to joke at Bloomberg that moving averages don't really count as technical analysis because everybody has moving averages on their chart. But of course, they're one of the earliest indicators and still one of the most used. And if price is above a moving average, we can argue that that's bullish because price right now is trading higher than an average of its prices over a set period. So now we're throwing more and more onto this chart. You could also look at volume and you could say, okay, if we're seeing price move out of a Bollinger Band, if we're seeing a new high, are we seeing volume confirming? Are we seeing heavy volume when we see that activity in price? And then we might throw on another indicator along the bottom panel to give us a sense of momentum. In this case, I put the MACD, the moving average convergence and divergence indicator on here. And if the MACD is crossing above its signal, or if they're both moving into positive territory, then that's another indication that we're getting bullish. So when you put all of this sort of confluence of events together, somewhere towards the bottom left of this chart, you can feel fairly confident that you're recognizing a new trend. The problem is that this is a very simple process, and we would work with people that would have a far more indicators on here, far more lines on the chart. But you can see even from this that it's getting a little bit busy, and maybe some of that traditional price analysis is a little hard to do because of what you've put on the chart.
And that brings us to the solution. So after years of work and sitting at the right elbow of institutional fund managers, traders, and analysts, Alex, you put all of that weight of the evidence, all of those tried and tested, the back testable and quantifiable technical tools into computation that happens behind the scenes. And what gets presented is just separating the signal from the noise in a really elegant, simple price chart that's color coded according to the trend conditions, the overall perspective, that blend of technical indicators. Talk to us a little bit about what the colors mean.
Absolutely. So we wanted to blend together those foundational principles and those sort of statistical ideas of measuring trend into something that just color coded price action based on trend strength. So what you're looking at here, if we go from left to right, the purple and pink colors represent a no-go trend, meaning that we're seeing criteria hitting on the bearish side. When you see the amber bars in there, that's telling us that there's not enough criteria being met on either the go or the no-go side to paint one of those two environments. So we paint them amber and call them go fish bars. Uh, Both fans of Jesse Livermore, he had a quote that we love that says, "There's a time to go long, a time to go short, and then a time to go fishing." So that's where we came up with the idea of the go fish bar. And you often see those bars as sort of transition between trends. And then as you move through the chart to the right, you're going to see that we have aqua and blue bars, and those are going to give us the two different strengths of a go trend. The aqua bar will come in when we're seeing weakness in the price trend, and the blue bars are the strongest go condition.
So building in a little sensitivity to the overall trend conditions, we know that we are still in an uptrend, right? The weight of the evidence is to the upside, but there can be periods of weakness within that trend. And we're going to talk at length about how trend following investors are going to think about scaling into positions. So when we talk about those outsized moves, the way that you achieve that is by looking at a very simple chart that says, no, we're still a go. Don't lock in those profits yet. We're still within trend. In fact, when you find those points of weakness and then a resurgence of trend, that's an opportunity to scale up your position or to get into a trade that you haven't already been a part of. So Alex, I know we're both really proud of this work, really excited about getting these tools into the hands of as many traders and investors as possible. And therefore, with the great folks at TrendSpider and this awesome implementation to a really powerful charting package, we're giving away GoNoGo Trend for free. Right, it's right in the TrendSpider template package. Alex, you want to talk a little bit about where folks can find that in TrendSpider?
Yeah, just adding an indicator is there, and that we're super excited to see it. I love the way it looks. The colors are fantastic. The TrendSpider chart is so easy to use, and so it's great to see it.
Absolutely. All we would ask for those of you who want to give it a try, use that for free. Just let us know. What are you trading? What time period? How's it working for you? Has it simplified some of your trade decisions? Has it helped you stay on the right side of probabilities? And from all of our mentors, we can't overstate the fact that price is so incredibly rigorous. As Ralph Acampora told me when I first joined the CMT Association, price is the first and most important indicator, right? Everything else is a derivative, and it obviously adds a lot of information, both confirmation or divergence from what we're seeing from a price perspective. But if we're stranded on a desert island, all we need to know is the price moves of a security. And it's Mark Abraham here who said, ultimately, it's the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, meaning only price pays. That consensus is revealed by analyzing price. So for everybody who's thinking about some of the fundamentals, they're thinking about their macro view. That's really, really important. But when it comes to buy and sell decisions, you really have to focus just on price. So Alex, just a quick refresher. We've talked about the GoNoGo trend indicators, building in some sensitivity from a strong bullish condition, weaker bullish overall trend conditions, that area of neutrality, or a time to take a break from the markets where there's too much uncertainty. The pink being our weak bearish conditions and purple being strong. Let's do a few of these just as an example of how simple it is to use the GoNoGo Trend Indicator. Just looking at the S&P 500, the SPY ETF, what are you seeing from a trend perspective, Alex?
Yeah, so we've had a really rough start to the year. That no-go move from the beginning of the year. We see the strong purples, the weaker pink as we rallied, and then back into strong purples. The no-go really dominated for the first quarter. The last couple of weeks, we saw a really healthy rally off those lows. We saw price move through the amber go fish colors and into a new go trend, right? So we've got aqua and blue bars being painted at the moment. Now, we've fallen away this week. And so we're going to watch if this trend can persist and if it can stay painting go colors.
What I love about this, right? If we were thinking about getting out of the markets at the end of 2021, at each of these rallies, we want to know, should we be getting back in? Is this the beginning of the next leg higher? And the overall trend conditions, again, this is a lagging indicator, but it's telling us we still haven't proven, right? There's still more evidence that needs to be compiled for the upside. And indeed, it's just continued to counter trend rally, but head back lower. when we saw this reversion back into Go Trends, then we know that maybe buying weakness, right, in within a Go Trend is going to be a way to stay on the right side. Alex, we can't talk about trend following without giving some credit to the OG technical analyst, his lordship, Charles H. Dow, father of the Wall Street Journal, the Dow Jones Indices. He talked about how the averages discount everything, that whatever fundamental information is running around Wall Street, it ends up in price. Mark Abraham has a lot to thank Charles Dow for. Charles Dow was also a very nautical man and talked about how there were trends in the market that existed on 3 different time frames. And he compared those to the tides of the ocean, the waves on the ocean, and then the ripples on the surface of the water. So when he's talking about the primary trend, he's talking about things that are structural in nature, very long term. These are going to be driven by things like the gross domestic product, the macro economy, the underlying fundamentals of the companies that we're considering investing in. And that primary trend is unflappable. It doesn't change with the headline news. It's a much slower moving trend line. But technicians have found in that secondary trend, the moves above and below what is the overall bias of the market or the macro economy, that we can find ways to profit off of irrational investor behavior, right? The folks that get influenced by those narratives, that are looking for an opportunity to chase yield. Of course, that gets overblown and then comes back, mean reverts back to that primary trend. We also know that there's a minor trend. And for many of you who are watching, this might be your zone. You might love the 5 to 15 minute candles, and you might be trading intraday. Keeping a perspective on what the primary trend or what the overall bias is. For you, the primary trend might be a daily bar if you're looking at those very short intraday periods. But we know that looking at multiple timeframes is really just going to help us understand the overall trend conditions and trade with probabilities on our side. So Alex, talk to us about the S&P again, looking at a go-no-go trend chart, but on a weekly time frame rather than the daily.
Yeah, so we work with a lot of institutional clients, and like you said, for any investor, these timeframes might be different, but you need a market bias, right? So you need to be able to understand for you what your overall market bias is. And on the weekly chart, which is where a lot of clients will start, we've gone back into a go trend. Now we can see that it's a weak go trend, and this week hasn't been that strong. But when you combine all of the inputs to the go no go trend, we've come out of this correction, and the weak go trend is back in force. Now that's important because if you're looking at the daily trend thinking, okay, will this daily trend persist? You can go to the weekly trend and say, okay, we're in a weekly go trend, we're in a daily go trend, and then you might go down in time frame, like you said, to something like a 60-minute chart, and then you might get a picture that is a little different, but one that you can use then for perhaps timing a better entry. So if we move forward to the 60-minute chart, you'll see that you can go from a weekly where you're saying, okay, I'm overall in a go trend, and then the daily, I'm still in a go trend, but it's weakened. So let me go to the 60-minute for some entry, and you can see that right now you wouldn't be looking to take that position on the 60-minute because we're in a no-go trend. So perhaps you wait for the shorter time frame chart to turn back to go conditions, so that you can get entry into the overall trend that you see on a larger time frame perspective. Now, if this continues to go no-go, that'll affect the daily and then ultimately the weekly. But you can use those multiple time frames to really get a good idea as to what's happening on all those different periods.
Alex and I learned this, working with large mutual fund companies. You have some meetings in the morning upstairs with the portfolio managers who are all looking at, weekly and monthly timeframes, structural trends that are moving through the markets. They also look to these trend following indicators. And then in the afternoon, when you get down to the trading desk, the folks who are trading the positions for those PMs are looking at the exact same technical tools, but on a much shorter time frame. And they're looking to get filled at, you capture a little bit of alpha as they get filled, find the low points in the day. And so for Alex and I, any technical analysis tool, any indicator worth its salt should work exactly the same way across any time frame. Which means for everybody who's watching, whether you are rebalancing an IRA account on a monthly basis, or you're day trading and you've got some YOLO Tesla options on, you can use these same charts in the exact same way. Now, of course, Alex being the subject matter expert for John Wiley & Sons and prepping people for the CMT program, He and I have both studied heavily the works of John Murphy on intermarket analysis, as well as folks like Marcos Katsanos, who've helped to quantify what those correlation studies are between asset classes. And so GoNoGo Trend is going to work not just on equities or individual securities, but we can look across all asset classes, and we can get a really great intermarket perspective on trends. So Alex, walk us through this round robin real quick.
Yeah, so just to give you again, might not be trading these markets, but to get a sense, like rates going up, rising rate environment, what might happen? Maybe you need to be looking at some flight to safety kind of ideas to see, where you might want to put money to work. So if we just look around these asset classes with something like the Go No Go trend, you can get a really quick overview of where those trends are. We can see equities are in a weak go, as we mentioned. Treasury bond prices are in a strong no go. Of course, prices move inversely to rates. Oil, the performer of the year so far, is still in a go trend. Bitcoin has come back into a go trend. Gold is in a go trend, and the US dollar is in a go trend as well. So you can sort of see how these major trends around the assets might affect some of the decisions that you might make on a portfolio basis.
Awesome. Well, this has been great. Thank you guys so much for taking the time to break this down for us. I know I'm super excited to jump in and play around with this thing, and I'm sure our users are going to be as well.